Hey everyone, welcome to the weekly review. And let's start with liquidity. This is the liquidity chart based on the uh, Fed balance sheet, meaning assets held outright and temporary assets. This is the one that spiked because of the sorry, wallet Fed balance sheet. So this is the one that spiked because of the banking crisis. And even on this version, we can see that the current SPX value is above the high range. Fair value is 3778. So this is really, really high. And when we discount this one and we go for the assets held outright, which is this one, this is the actual Fed balance sheet, and this is the QE part. So any QE that happens makes this go up. But for the other one, this goes up even when QE doesn't happen. So let's put them together. And just to show the comparison, in 2008, this was uh, uh, this was the initial reaction to the market crash, and we can see that the Fed balance sheet went up, but the assets they held did not go up. And when we also add SPX to this, let's give it its own axis because it's a different scale. This was SPX during the market crash, and you can see that the market crash continued. Actually, the crash started here, and they reacted immediately by borrowing to the banks, but the crash did not stop until QE actually started. So uh, WLALCL, it's Fed balance sheet temporary assets plus assets held outright by the Fed, and this is the one that spiked during the recent crisis, not assets held outright. So it wasn't QE, it was just Fed balance sheet going up, which in the big picture is still liquidity, and that's why the market went up. But right now, even when counting based on that, we're still above the high range of this area. And when we look at the assets held outright, it's way, way, way above the upper band. So liquidity is not looking very good. On top of this, there's this other indicator, which is which tracks central bar dark energy tracker, which tracks uh, central bank liquidity for all central banks. So this is BOJ, this is ECB, this is Bank of China, and obviously the Fed, Bank of England, stuff like that. And you can see that it tracks uh, SPX movement pretty accurately, and this is where QE started basically. And what were we seeing at the top here? It was a divergence, so liquidity was making lower highs, market was making higher highs. And as well here, look what happened on Friday. On Friday, in spite of uh, market going up, liquidity actually went down. So this matches up with what we're seeing here from this. So the market went up as liquidity was coming down. This is a fake rally if we ever seeing one, but this doesn't mean that it will stop. So let's go into detail. First, a small recap of what happened last week. We just closed the month for trading, and we can see that the monthly went a bit higher. The quarterly, we haven't taken out the quarterly highs from last quarter. The weekly, we've been basically stuck in this range here of this week from the April 10th, and we overshot and undershot it as this week. So let me turn on the ranges. This is the April range, and it's identical to this weekly range because this week we took out both the lows and the highs of the April range until now. And this is the week I mentioned. So this is the weekly candle. And when we look at lower time frames, we can see that the midpoint of this weekly range was very important. The bottom of this weekly range was tested multiple times, so we have it here, here, here. We tested it here and held once. Then we overshot a bit, went back above it, and back tested and went up. This was the range this was the line I posted earlier this week on VTards, and where we back tested and went up. And then we went above the midpoint, backtested again the midpoint and held, and then went above it. But just like this here, this has a high chance of being just an overshoot that will take us back inside very quickly. Now, this being said, like I said, the divergence to liquidity can keep going for quite a while. A while meaning like a few weeks at max, not very large amounts of time. And the levels we are looking to see next week, let me put it in different color, are these. So if we don't open red on Monday and start going down like crazy, these are the levels to look out for, because if the rally continues, this is where it would likely stop. And first we have the top of the quarterly range. So this is the top of the quarter at 418.31. And if we get above that, I would expect we will close the gap here at 421.22, and we stop there. I don't see us going above 420 and staying above it. This should be like a quick 1 hour poke above it and then turn back down. I put that exact price in the delta profile thing, and let's look at what the delta profile will look like, the positioning indicator. And we can see that it would be above the February high, above the March 2022 high, and very close to the bull market tops. And just as a percentage wise, if you want to know how high it would be, it was be 91%, so above 420. And expect this to be even higher because buying will create more buying. So I would expect it to be like 93, 94-ish in real market conditions. If this happens, I'm going short big time, and whatever happens. I will have no regrets. So let's take liquidity out. That's another topic that I will get into quickly in a few minutes. Okay, so let's go at the lower time frame. What are we looking to see here? So we went above that weekly range that I mentioned, and these are the levels we're interested in. What we want to see for the bullish case is just like here, turned this level into support. So for the bullish case, when we should inevitably go down on Monday, pre-market I mean, with VIX spiking, and I'll show in a minute. We want to turn this 415 level into a support and then continue going up. This level will be resistance, and I would expect a quick pullback from it, but then maybe it goes higher, turns this into a support, and goes as high as this, maybe overshoots a bit, and then we should see like a very large collapse. Now back to the VIX. What do we see about the VIX is the rally the past 2 days was only VIX crush. On Thursday we had a 9% day down. On Friday we got a 7% down. It was VIX crush after VIX crush. We're getting to multiple trend lines soon. This is a horizontal level from way back. This is a potential downtrend trend line like this. This is also a potential downtrend trend line like this. It's not drawn very accurately, like something like this. So we're coming to a combo support area. We see a bullish divergence, even though price went lower. This is still higher than the previous low here. So it's looking, even though we got crushed on Friday, it's looking pretty good for VIX as well. And just as another indicator, VVIX on Friday was not down. Usually we want to see, like here, for example, on Tuesday and Wednesday. So Tuesday, Wednesday, we see VVIX actually starting to go down before VIX went down. So whatever VIX does first, VIX usually follows. And what do we see on Friday? In spite of VIX's minus 7.44% down, VVIX was up 1.29%. So this is another indicator that we're getting a VIX spike soon. Then on top of this, we have RSP, which is equal weight SPX, and we can compare it to SPY. We have a divergence here. This is higher high, a high and a lower high, while I'll add SPX here. We have this. Usually when this happens, sorry, I have to pin it to its own scale so that it doesn't move around. First of all, this you see this following very accurately. And then when the rally started in March, it was all mega caps. This is why this SPX is higher than equal weight XPX. Secondly, we have this divergence here, which is like this. SPX making higher highs and higher highs, and equal weight XPX making lower highs. This usually happens at the top as well. Didn't get it here. I'll show the other one, which is QQQ. This is equal weight QQQ. Same thing, very large lower high here. And if we add QQQ to this one, like this as well, generally speaking, follows it quite well. This went much higher. It dropped lower and went much higher. We already have a much higher high relative to this. So these are all divergences that we need to be on the lookout for because they don't usually indicate strength. Oh, I didn't want to do that. I wanted to go at the high. That's it. Okay. Next up, we have the ratio between RSP and SPX. So this is um, when when market breadth is diverse and everything is going up at the same time, this usually goes up. So the rest of the XPX versus the mega caps or the tickers weighted uh, towards the no, how do I explain this? I think you guys get it. So this is mega cap, this is the market going up, this is mega caps going up. The items, the tickers with the highest weight going up, this will go down. And this can resolve in two ways. One, the entire market goes up, mega caps kind of stall, and this is sort of what we got on Friday, with the market breadth being very decent. And the other one is uh, mega caps dropping and the rest of the market dropping less. On Friday we got the bullish version, and if this is truly a bull market right now, this is what should happen. So we should see this ratio go up, mega caps sort of stall for a while, and get all the things that had been dumpstered go up from here, like IWM should go up, Dow Jones should go up, all the beat up tech should go up, everything should go up except mega caps. Mega caps should not have gone up enough. They should not drop because if they drop, they will bring the market with them. But the rest of the market should start going up and we will see this ratio improve. Besides, the other option is if mega caps go down. But if mega caps go down, the entire market will go down as well. It's nearly impossible for the market to go up while mega caps have significant drops. Another thing, like a canary in the coal mine is DJT. DJT is the transportation average, and relative to SPX or Dow Jones, let's see, yeah, DJT is a canary in a coal mine. because it signifies quote unquote the real economy. Major divergence here. Higher highs, much lower low. This is kind of it for the case for a drop. Let's look a bit at the mega caps to get some levels, and I'll end the video with some macro stuff. Okay, so let's do Tesla. So volume. So Tesla had short-term volume is bullish, but had a lot of volume for June puts, and this is the volume. Actually, this is the how much delta it represents for June, and this is January 2024. And what we need to see is this could have been hedges, or there could have been long puts. And we see here that the volume for, first of all, January 2024, it's this. There was a couple of bit here, and this is more likely to be hedges, but this is definitely not a hedge because it's deep in the money. So someone bought a lot of 450 puts, 416 puts, 366 puts. These are all way too deep in the money to be hedges. Someone just bought puts deep in the money puts as leverage. With the same money, the reasoning behind buying deep in the money is to use options as leverage. You don't lose a lot of value uh, relative to how a stock moves, and you just get the chance to buy a lot more stock for the same money with deep in the money puts. And the other one was June, and a couple of here as well, but this 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 also deep in the money. So I doubt this was a bullish bet. And at delta profile, where are we? We are at 160 something, 164. 164 around here, and we look at OI. It has a nice ramp going up to 180-ish. This gap here doesn't really allow a move, an easy move above 180, between 180 and 200. So it has to get 180 first, and then we'll see. And support would be 150. If we look at the delta profile, the low was 152, and now it's going up. And this is 180 here, approximately. And we have this level here, tested here, tested here. So it's a horizontal level. This area between 179 and 186-ish, probably towards the lower side. So this area here is our target short term if the market continues to be bullish and Tesla continues to go up. I would start looking for a short back at this level. Apple, because Apple also has earnings. Oh, sorry, stay on page. First, we look at volume. Surprisingly bearish volume for May, and not only in OI but also in Delta. Next week is bullish, but the following week with OPEX is not. Oh, not the following week actually. I think it's 3 weeks. Yes, 1, 2, 3. It's all in 3 weeks. So next week is bullish. The one after that shouldn't have a lot of volume because nobody cares about 2 weeks ahead. But the quarterly, not the monthly expiration has quite a bit of bearish bias. And also for for January 2024, got a bit of put volume. So let's look at what strikes. So let's first this. So it was 167.5. It's down. This could have been hedges. Can be long puts as well. Not really conclusive. But for next week, it's looking like it really wants to go above 170 briefly. Apple is 169.68. So let's get delta profile now. OI wise, there's much more call OI for week up to 175, and I think 175 is the limit it can get to. Again, this is a very small move. Like, how much is it from here to 175? 3% ish. Yeah, 3% ish. So I think that's the cap, the top. Backtest this with the market at 415, then go up, then go to this, and I don't know. A blow off top is this. Like, let's say we get a bullish reaction per earnings that is on par with Microsoft and Meta. Yeah, 175 target. I suppose you can get to 180, but I wouldn't bet on more than that. What was the level? 182, almost 183. Ending this bull phase with Apple getting to a new all-time high seems appropriate, honestly. Okay, Meta. So for Meta, we already know the target is 250. I very much doubt that we will get this gap filled anytime soon without a major pullback. Considering Meta, I think is the best performing stock in the S&P this year. Year-to-date performance. Nvidia 89% and Meta 99%. Yes, the best performing stock. Okay, so let's look at volume and OI. This is bullish, quite bullish, also quite bullish. So yeah, I think we see 250. Will be a magnet, but going above it is questionable. I don't see it happening. Like, because also the next level is 300, the major level is 300, and there's not a ramp to it. It's a decreasing ramp, not an ascending ramp like here. Like, all of this was helpful. This won't be helpful, especially since no more puts. Who's next? Nvidia. So for Nvidia, this still stands. Don't think we can get above it. So it's 290-ish, let's say. Look at volume. For next week, the rest was relatively small. Nothing really stands out. Let's look at OI. It's now at 277, so around here. The thing with Nvidia is it doesn't have a good ramp. Theoretically, 300 would be a target, but it doesn't have a good ramp to 300. Again, this type of ramp up to 300 was nice, but this gap here is pretty big, and also no puts on this side either. Getting above 280 seems quite questionable, and like any kind of move above 280, I would consider to be a blow-off move. So that's why the target for Nvidia is not 300, because it should have no ammo to get there. Okay, next, Google. No, Microsoft. Let's do Microsoft. Microsoft reached the 305-ish target. It even went above it. Next one is this. And I think if we include these lows, it would make it this probably. I'll keep it 315 for now. the blow off move. Volume. Nothing really standing out. It's bullish, but nothing really standing out. Don't see 310 was the biggest one for next week, so I think we hit that. Delta profile. We are at 307, slightly below this. This is a good level. For next week, we had 312, which is good for ramp up. We have some puts for May now coming in at 310, so that those will help it a bit. I can see it getting to 315. Sort of the same kind of look here with Nvidia, but the ramp up is better. And it also has some puts at 310 to burn. So I would say it's plausible to get to 315 as the blow-off move. Microsoft, next we have Google. $107, let's look at volume. This is quite bullish for next week, quite bullish for uh, the following week as well, and quite bullish for May and for January as well. This is quite a nice ramp up for next week, and it's not just for next week, it's for June and May as well, May expirations. So I would say we hit 110 almost 100% next week. What were these puts here? For June. Deep in the money. Someone bet against it as well. And at the OI ramp, yeah, no. I mean, 110 is doable because we're almost there as well already. But again, this gap is pretty huge and there's no fuel for it. So I doubt we go above 410. 110, sorry. Yeah, there's nothing here either. So if it gets to 115 for any reason, I think it gets to 120 as well. But to get above 110 up to 115 is going to be very difficult. I don't see it happening. Amazon. Amazon also respected this trend line. It's pretty clean. Let's look at volume. That bullish. We have a lot of 110 as well for next week. The ramp up is good to get to 110. After that is questionable. But delta profile looks much better. What's this? This is 2024 January. There's a lot of puts for January 2024. This is June, I believe. No, this is May. So orange is May. This is June then. Amazon looks from an OI and delta perspective looks much better. It actually has a good ramp to get I don't know, to 120, 130, but I'm assuming not in the immediate future. Finally, XOM. So for XOM, I kind of got what I expected, meaning I thought they would do very well for earnings because it's fucking oil and they're printing money right now. And I got what I thought we would take out this high from here, this one, horizontal level, uh, And right now, I think we will continue doing this. So expect another attempt to go above it next week. If it has a close above it, be careful if you're short. We don't want to see it close above this level. But if we keep seeing rejections, uh, this is highly encouraging because I think it will turn down relatively soon. So going back to volume, huge volume for 120 for next week and for May. After that, it's very, very weak. So it was similar last week as well. We look at OI profile. It's 120, big gap until 125. Maybe it gets to 125, but after that, this down ramp, there's no way this can push it higher. So I think it will stop somewhere between 120 and 125, but closer to 120 than 125. Basically, this. It will go overshoot a bit and then eventually drop. Now, for the final topic for today, it's recession. And I'll start with this thread. That's a thread by Max Rokatansky. And it's a couple of things from earning calls, which I will add to as well. First one is CDW, which had this comment during the earnings call. The 1Q was marked by a period of intensive economic uncertainty that led to our customers to spend more cautiously. We currently expect the US IT market to decline at high single digits rate in 2023. This was just months before they're forecasting flat market growth as well. They do IT services, cloud stuff, security, that kind of thing. The other thing was this is the Philly Fed Outlook survey, and we are very low. This usually means recession. The conference board LEI, again, this below this level usually means recession. MACD, the comment from MACD about we are seeing a slight decrease in unit per transaction. So things like someone adding fries to their order, how many items per order, we're seeing that go down in most of our markets around the world. Slightly, but it's still going down. And then the other thing is we are seeing in some places resistance to pricing, more resistance than we saw at the outset. So basically McDonald's is saying that people are not buying as many products. They're not adding fries, they're not, I don't know, getting drinks, something, stuff like that. Slight, but it's the beginning of a recession, not the end of a recession. And we don't know how deep it will be as well. Then we had UPS, which had this comment as well. Uh, we expected in January, February a little bit lighter, but March was the trail-off. The rate of acceleration in the year-over-year decline caused us pause because we were down around 3% in January, 5% in February, and 7% in March. April has stabilized relatively how to how we exited March. This is a bit more nuance in reality because they followed up and said it was because of planned uh, capacity drops that they agreed with the clients ahead of time, but still that you don't know which one is real. Is this a real thing, or were they sugarcoating it at the end? And not only this, now that we had the majority of companies release earnings, what did we see? We saw mega caps outperform by a lot, and other than that, what other tech companies did well? We had the cloud guys do decently, but we also had a bunch of hit and misses. Like we had Datadog, I think they did well. Not a Datadog. Someone reported earnings and they did something good. I don't know. But we also had Net with a big dump. They said that it's difficult to acquire a new customer. It's more difficult to acquire new customers. We had Snap and Pins dump as well, in spite of Facebook's good earnings, even great earnings, in spite of ad revenue going up. For Meta, for Snap and Pins, this was catastrophic earnings. and or not really catastrophic guidance. The reaction was catastrophic. And we also had Amazon. Amazon initially went up 11%. So this was 223. So initially, this is where the candle started. It spiked up 11.72%, and then it went down. Do you guys know why it went down? Because the CFO said during the earnings call that they are seeing 5%, 500 basis points, which is meaning 5% drops in AWS revenue month quarter over quarter. So they said that they saw a slowdown towards the end of the quarter as well, and then compared to last quarter, in April, we are already seeing numbers 5% down quarter over quarter. And that's caused the drop in Amazon. On top of this, we had the GDP uh, numbers come in this week, and it was 1.1% up. But what I'd like to draw attention to just to play on the thesis that a recession might have started in March or potentially in April. Again, not the deep recession yet. It's just the beginning. It might end up being shallow. It might end being very deep. We don't know. But the thing is that data seems to indicate that it started in March and April. And I will use the Fed forecast for GDP estimate from the Atlanta Fed as a tool to describe this. So what happened earlier in the year? We had that huge NFP beat that nobody expected, which caused the spike in yields. Let's go back here. We look at yields here. This is the 10-year. This part here, this part here in February came because of that huge NFP beat, and the market panicked a bit because the Fed was supposed to keep hiking and stuff like that. And this was due to bad economic data. This was the recession scare. But this was the NFP huge beat, meaning a lot of new jobs were created and the economy was booming. At the time, this was explained as mild weather, milder than expected weather, improving seasonality because people worked more than they usually do around that time period. And GDP is directly connected to the amount of people working. The more people work, the higher GDP will be. That's why unemployment or employment is the how the Fed is trying to combat a heating economy. To slow down the economy, you need to slow down GDP, and you do that by increasing unemployment. So if we had an unexpected bump in employment in this period, and we did because let me here. This is the unemployment level, and we saw it bump up a bit in February to what was this 3.57? I don't know whatever it was here, 5.88. No, 3.6. Sorry, and then it came back down again. So more people than expected were working, and more people working means higher GDP. And the Atlanta Fed estimate went hand in hand with that. So more people working. What were the GDP estimates? Well, 2 plus, and it kept going higher. Like these things have like a 2 weeks to a month lag, and around March, mid to late March, it was as high as 3 point something 6. So data from January and February and probably the beginning of March, based on that data, they thought that GDP would be up 3 point something percent, 3.4%. But then it abruptly starts going down and going down quite a lot from 3.4 to 1.1 in the end. Now, if January was a hot month and had a large GDP increase, if February was a hot month and had a large GDP increase, then to go back down from 3.4 to 1.1, March uh, should have been a very bad month with a cold GDP, a negative GDP print. But we don't get month-to-month GDP data. We only get it by quarter. But the only way to explain this is January was hot, February was hot, and then March was very cold. And the average came down a lot in March compared to what the numbers were tracking at the end of February. So this is one explanation, and another thing that might explain uh, or gives a bit of credit to the idea that the recession has already started in March or in April. And what do we need to do to confirm or infirm this? Well, next week we get jolts and unemployment and non-farm payrolls. What we will see in these things, if the theory holds true, is jolts will drop a lot. 9.7 is way, way too high if the recession has started. I would expect this to be below 9 uh, by the time it's reported. So to confirm this data, we need to see jolts dropping a lot. Then we need to see unemployment go up. So 3.6 is a bit low. I would say 3.7 at the minimum to confirm that the job market is turning and we're seeing unemployment rise. So a minimum of 3.7 unemployment would be uh, a, a bit of a confirmation for the recession theory. And then non-farm payrolls, we need to see this drop. If jolts dropped, non-farm payrolls should drop as well, because if demand for labor decreased, less jobs should have been created as well. So this is the theory behind the recession that Max put up here. The recession began last month, which I sort of agree with. I'm not sure if it was exactly March, but somewhere between March and April, or somewhere in March or April, it probably began. It's very shallow for now, so not don't panic in any way. But we should be starting seeing economic data come in really, really bad and cause another recession scare. And this is what will turn the market, because the market will overreact if the recession data comes in. So this is the reason why we should see a significant turn down in the market if the data confirms this theory. Okay, guys, I think this is it for this week. I talked a lot, explained quite a bit, I think. Good luck for next week. And remember, these divergences can persist for quite a while. Don't get caught on the wrong foot so that you have to cover before the party starts. When we hit these thresholds, you can go big, but until then, play smart. You can play the market both ways. Don't go crazy in either direction until we get a clear confirmation that or hit a target level. Have a good week and good luck. Bye bye.